My name is Ayodeji Owoeye. I'm a lecturer in finance at the RAU. So a little bit about myself. I have degrees in economics, banking, and finance. I have professional certifications also in banking, accounting, and management. Uh, I started my career as a college lecturer uh, way back in 2001. And after then, I worked in the banking industry for a decade. I worked in credit risks, risk management and audit. And also I've been teaching and doing research in the UK for almost a decade. So that's that's it about what I do. So can you tell me what you do? What about you? So in the chat box, so you can easily signify what you do. Maybe tell us about yourself. Maybe you're a business owner, you're a college professor, maybe you're an accountant. Simply tell us what you do. In the chat box there. Right. So some people, yeah, some, some people are business owners, entrepreneur, lecturer. Yeah, good. So what can you now type in? What is your expectation about today's seminar? What do you expect to get out of today's webinar? Right. So one of the participants said that to learn about issues of getting and supporting mortgages in emerging economies. Brilliant. Brilliant. I hope I'll be able to meet the expectation. So let's start. Right. Household access to mortgages in the emerging economy. So according to UN Habitat, uh, affordable housing should be for all. So everybody should have access to affordable housing. However, that is not what is always the case. Many people are homeless or living in substandard accommodation, and this is a peculiar challenge in developing and emerging economies where many people don't have good accommodation or are living in substandard housing. So today's discussion will focus around the supply side of the mortgage market. So the mortgage market is divided into two main parts. We have the demand side and the supply side. So today I will be focusing on the supply side. So supply side basically looks at how banks and financial institutions can grant mortgages, what factors could lead to them granting those mortgages, and all issues surrounding supply side of the mortgage market. That's what we'll be focusing on today. So now I'm going to look at the difference between developing and emerging economies, advanced economies and emerging economies. What are the main difference? So I'm going to look at the classification of countries based on income. So countries are classified according to the World Bank based on these four income criteria. That is, you have countries with high income, upper medium income class. You have low medium income countries. Then you have the lower income countries. So I'm going to be looking at those classifications to actually make a distinct characteristics between advanced economies and emerging economies. So I'm also going to look at other criteria such as public health, labor market, fiscal space, and governance. So I'm going to use those characteristics to differentiate between advanced economies and emerging economies. So using World Bank World Bank data and information. So this table basically was a World Bank publication in this year. I think it was published in April 2020. So looking at various income characteristics of emerging economies and the advanced economies. So based on this classification, I'm going to discuss the differences. So looking at so we have the income criteria, which differentiates countries. Then we have the categories. So I'm using these 4 categories to quickly make a quick distinction between advanced economies and emerging economies. So let's quickly look at public health. So under public health, I'm going to look at hospital bed per 1,000, the number of physicians, then I'll look at life expectancy at birth. So if you look at hospital beds per 1,000 from 2014 to 2018, so it says that for a low income country, so just 69 people will have access out of 1,000, we have access to hospital beds. While in developed or advanced countries, we have almost half of almost 500 people out of 1,000 that was subject will have access to hospital beds. So if you look at the number of physicians out of 1,000, so out of 1,000, so physicians, nurses, midwives. So in low income countries, just roughly 2% out of the 1,000 we have access to physicians. However, it's almost 12% in high income countries. Then if you look at life expectancy at birth, in high income countries is 81, and for low income countries 62. So how does this impact on the mortgage market? Because a mortgage will last for a period of 30 years. So low income countries banks may not be willing to grant their mortgages because of the short time life expectancies. And people could die if they don't have access to hospital. And those are the characteristics that a financial institution will look at. So if you look at another category, which is labor markets. So under labor markets, so you have this criteria which says that informal labor estimate as a share of unemployment is 93% for a low income country, but for a high income country is almost 15%. That simply shows that majority of people in the low income country works in the informal sector. And one of the characteristics of people working in the informal sector is that they don't have a regular source of income. So, and we know that your stability in income or regular income is an important criteria that will ensure when a financial institution is assessing you to grant you mortgage. So furthermore, self-employment as a share of employment. So people that are self-employed within an economy. So for a low-income country, almost 93% of people in low-income country are self-employed, and for the high-income country is also very low. People that are self-employed is very low. So if you look at this criteria, how that impact on the mortgage market is that people that does not have a regular source of income may not have the ability of them to get access to mortgages may be restricted because of their income status. They have a low income status. So that's that. So the next category I'm going to be talking about is a fiscal space. So under fiscal space, I will look at the domestic credit to the private sector. So we know that the private sector drives the economy. A robust private sector will always drive the economy in terms of income generation for the government, in terms of employing more people, in terms of providing infrastructure in the area which they operate. Now, if you now look at that, domestic credit to private sector in low-income countries is just 14%. However, for the high-income countries, you can see the share is very, very high, more than 100%. So that simply shows that private sector thrives more in advanced economy. And the reason for that is not far-fetched, which we are going to look at shortly. So we have a foreign currency long-term sovereignty debt rating. So the debt rating is from low means low for it starts from 1, then high is 21. So that simply means that as your rating increases, then you can easily attract international funds from foreign capital markets or capital market abroad to boost the investment capacity within your economy. So if you look at low income countries is 7, while high income countries is almost 17. So you could see the disparity in terms of fiscal space. And let's look at tax revenue. Tax revenue. So you have more taxes are collected in high income countries compared to the low income countries. So when government tax base increases, then government can be able to provide infrastructure. And once infrastructure facilities are well in place, as a consequence of that, many people or households will be able to access mortgages because the cost of providing such infrastructure has been already covered by the government. So that's another distinction between low-income countries and emerging economies. Another bit is the governance. So under governance, you could see government effectiveness. How effective is the government? We have regulatory quality, rule of law, control for inflation. So if you look at the data for emerging economies and developed economies, so you could see there is a big disparity. So for low-income countries, you could see that there is evidence of inefficient government policy because the data signifies a negative impact. So you see that regulatory quality is poor. You see that rule of law is also poor. Then in terms of emerging control for corruption, you can see that in low-income countries, there is no effective control for corruption. However, in advanced economies, there is effective control for corruption. Right. Yeah, somebody said my voice is not that clear, so I will make it as audible as I can. Now, how does governance impact on the mortgage market? Governance impact on the mortgage market, for instance, control for corruption. A corrupt society will definitely not make mortgage market so effective. So people can because of corruption, people can overvalue an asset, and as a consequence of that, people that cannot pay for a particular asset will be granted credit to buy a particular mortgage. We could see what happened in years back during the global financial crisis. Then in terms of rule of law, and a country where rule of law operates simply means that banks or financial institutions can easily realize their assets if, for instance, the asset goes bad. And quality of regulation also impact and effectiveness of government policy. A good government policy, for instance, in the UK is the Help to Buy scheme. Help to Buy scheme will also always help people that are about to climb the property ladder to easily get access to the property market. They can easily get access to mortgage. A good example is the Help to Buy scheme. However, in less developed countries or low-income countries, access to effectiveness of those policies may not be there, and that will restrict access. So based on this, you could see that there is a big disparity between countries in the low income category and countries in the high income category. Right. So let's pick a case study. A case study is just for us to discuss this into details. So how do I pick a country to research in this instance, to look at how access to household can in an emerging economy? So I'll look at a very large economy, a country that has a big population. So the population will show the diverse set of people. So you can easily see different category of people, low income household, mid income household, and the high income household. A country that has a commanding height in the region which it is located, and a country that has a key financial hub with a range of international banks and availability of data sets. So looking at these characteristics or criteria which I've set, I think Nigeria is a good case study. So why I choose Nigeria? Nigeria is the largest economy in Africa. Nigeria has the largest population in Africa. It's only 6 countries in the world that has more population than Nigeria. Nigeria is a commanding height within that particular sub-region and in the region. Nigeria has a lot of, is a financial hub for West Africa and has a lot of international banks. So we have, there is HSBC, there is Barclays in the economy. Then we have available data sets. So the data set to do the studies already available. And that's why I choose Nigeria as a case study. Now, so let's look at the Nigerian profile. So Nigeria has a population of 206 million and is growing at a rate of 3%. Nigeria has the largest economy in Africa, with a GDP of $475 billion. It is the 23rd largest economy in the world. It is a commercial and political center for Africa, very rich deposit in natural resources and crude oil and natural gas. Most of the states in Nigeria are richly endowed in natural resources. Nigeria is the largest exporter of crude oil in the world. Very large, very big expanse of land. It has been politically stable. We operate a federal system of government where we have the federal government, state, and the local government. The financial sector have been relatively stable since 2012. There is regional and ethnic differences. Nigeria is made up of 6 main regions and 3 large ethnic groups. So some religious crisis and regional violence, which actually impact on households' access to the mortgage market. So looking at the structure of the Nigerian housing market, So the Nigerian housing market is structured into 2 parts mainly. So we have the formal housing and the informal housing. The formal housing is a housing structure that is well organized, well structured, meets all the building regulations, those type of houses can easily get access to mortgage finance. So meets all the building regulations. So, and the informal housing, on the other hand, is a housing structure that is not well organized, not structured, does not comply with building regulations. So let's look at it into details. So 15% of people of the housing market in Nigeria is under the formal housing structure, while 5% of them are the formal open market, where the upper income class of the population do play very active role in that particular market. So we have Abuja, Lagos, Port Harcourt, and Kano. So under the informal housing, we have a government assistance housing structure, which is 10%. People here can easily access financial institutions for credit to buy their desired properties. The informal housing structure, on the other hand, is made up of 85% of the population are in the informal housing structure. Many of the people living in urban centers, basically are under the informal housing structure. They use more 40% of their salary as rent, particularly in Lagos, and their access to the mortgage market is restricted. And the main reason for that is that they are priced out of the market. Properties are mainly located in suburban areas. Access is through community and cooperative societies. And basically, how people here get to thrive in the housing market is what is known as the informal mortgage market, where the cooperative society tends to get money from the formal sector, which is known as transmission mechanism. So that is the structure of the Nigerian housing market. So let's have a quick look at the Nigerian financial market and the mortgage market. So broadly, the Nigerian financial market is broadly stable, well capitalized, and profitable. So restructuring has been carried out sometimes ago, that was in 2005, 2006, where capital base was increased. And as a consequence of that, banks become bigger, larger, and they can easily compete within the financial market. So banks always compete within the financial market. And the impact of competition is that could lead to low interest rates and lower cost of borrowing. So because of competition, banks can reduce interest rates to count an inch for themselves in the market so that they can make more profits. There is also the presence of concentration. So the presence of market concentration is based on the evidence of foreign banks in the Nigerian economy. And as a result of concentration, that will open up an economics of scale where people can easily get mortgages at a reduced rate. So looking at a broad classification of the banks in Nigeria, is classified into three. So we have these first generation banks, which is usually classified as big, strong, and reliable. So the first generation banks, there are 6 of them. They are big, strong, and reliable. So they play active role in the Nigerian mortgage market. And we have the second generation banks and the third generation banks. The second and the third generation bank basically don't actually play very active role. So however, banks in Nigeria always practice credit rationing. So what is credit rationing? Credit rationing is when banks uses lending rates to signal and screen customers. So they use interest rate as a tool to screen customer and other lending criteria, such as your age, your income, your family structure, if your wife is working, all those characteristics. So they are mainly particularly in using that to signal to ration customers. So having looked at the structure of the mortgage market in Nigeria, looking at the housing market, then let's quickly have a look about the macroeconomic problems peculiar to the Nigerian housing market. The first thing is there is high interest rate. There is high interest rate. The interest rate is between 18% to 30%. So that simply is being used as a tool to price out many customers that will reduce their access to be granted mortgages. Then we have high inflation rates. Then we have volatility in the oil market. Nigeria is a monocultural economy where it depends on oil for its main revenue. So once I say volatility in the oil market, then Nigeria economy shrinks because most of the income, oil income, is being gotten from there. So currently now the barrel of oil price is very high. So we have a low growth rate, slow growth rates, that is high unemployment. So 85% of the population are not in well-paid jobs, and where 10 million people have lost their jobs in the last 12 months. So as a consequence of that, the economy has slowed down. So we also have a fall in national output due to terrorism. So Boko Haram and elsewhere are ravaging the economy. And currently we have the impact of COVID-19 on the Nigerian economy. So remember we talked about not having access to good health care, and now we have the impact of COVID-19. This is actually ravaging the Nigerian economy. So we could look at, if we want to look at this, we could see there's a link between volatility of oil, slowdown in the economy, and the impact of COVID-19. So let's quickly look at the impact. So what I want to discuss here is just the impact of COVID-19 and a weak oil price on the economy. So as a consequence of impact of COVID-19 or weak oil price on the economy, in terms of the fiscal perspective, so there is a reduction in oil prices, oil benchmark has reduced. That puts pressure on the revenue base. So as a consequence of this, there is a review of the budget, and the government is now, the option left for the government is to debt finance the economy. So if the economy that is being financed by debt may not actually encourage access to the mortgage market, because many lenders will be cautious of the economy, and they may not be willing to lend to households in the economy. So from the monetary part, this actually led to depreciation of local currency, and as a consequence of depreciation of local currency, as it stands now, £1 is around 525 Nigerian naira, and as a consequence of that, that puts pressure on high pressure on inflation rates, and this leads to liquidity issues. So there are liquidity issues within the economy, and once there is a liquidity issue, then financial institutions may not be willing to lend or to grant access or to credit within the mortgage market. So the impact within the financial institution and market is that there is a possibility of a recession, financial crisis, a decline in foreign portfolio investment, and a decline in foreign direct investment. So foreign portfolio investment is just a security or securities and other financial assets held by investors in another country. So if foreigners within Nigeria, investors are not willing to invest in the economy, then that's a bad sign. And when that happens, also banks or financial institutions may not have the capital to actually lend within that particular economy. So we have reduced access to credit, resulting in liquidity tightening, and the financial institution basically will experience a reduction in profit. Now, if that happens in the financial institution and market, then what happens to the banks? So banks will be exposed. There will be a lot of credit exposure and losses. And as a consequence of this, there will be challenges of foreign exchange flow, and that will lead to operational constraints within the bank. So what happens? The impact of this flows to the businesses. So what happens to the businesses? Businesses are going to experience reduced revenue and profitability, disruption in the supply chain. Businesses are linked together, cannot get our products to each other, and as a result of that, there will be operational constraints. Then the impact now falls on the households. What impact would this have on the households? Households are people like you and me. So we are going to have a reduction in income and purchasing power. Then there was going to be a change in their consumption pattern and a reduced standard of living. It is only when you have a stable income and your consumption pattern is tending towards buying a property that you'll be thinking of accessing mortgages. And that's the impact of a weak oil price and COVID on the Nigerian economy. Now, how am I going to test this? So I'm going to model this, the discussion we've been having, then I'm going to use data to model this. So we know that the role of finance is critical to any economy, and it's also critical to the development of the mortgage market. And remember that lending is one of the most important functions of the financial institutions. Long-term funds, which is critical to the mortgage market. So the ability of banks or financial institutions to lend, that is to grant long-term credit, which is needed in the mortgage market, is key if the housing market is to survive. So I looked at these 4 papers. So based on these 4 papers, I developed a model to look at the constraints in the financial institution which prevent access to long-term funds needed in the mortgage market. So the model is just a 4-stage model which was used. So this is the model. So the model basically captures the bank-specific factors, industry-specific factors, macroeconomic factors, and institutional factors. So what are bank-specific factors? Bank-specific factors are factors within the bank's control. So factors are what the banks can control, and that is at their disposal to determine if they will grant access to credit. So I consider the capital. Capital is what bank stands on. A well-capitalized bank will be willing to lend the long-term credit needed in the mortgage market. Why a less capitalized bank may not be willing to do such. So we have a credit risk basically captures the risk exposure of the bank. So if bank is lending too much credit, if they have too much credit lent already to household, they may not be willing to grant further access of credit. And they may not be willing to grant long-term credit like for 30 years that is needed, that a mortgage is. So we have operational expenses, the cost of running that particular business. Then we have management, the management style. If it's the management style is dictatorial, autocratic, or a management that is good, that people are willing to work with. Then the size of the bank. Then I looked at the industry-specific factor. So basically looking at the industry, the financial institution as a whole. So I consider market power and concentration, financial depth of the industry, and the bank ownership status. So market power basically means that banks within the financial market that can control what happens within the industry. And once that happens, then banks could determine what to lend, how to lend, and when to lend, at what interest rate. So if market power exists in that particular industry, that will impact on how much a bank could lend. So the financial debt basically looks at how deep the financial institution is to avoid shock if there is a particular event that happens. For instance, in the US, there was Hurricane Katrina, which swept away almost a whole town. So if the US does not have a good financial debt, that could wreck the economy. And currently now, most countries that experience a deep problem of COVID, if that economy does not have the financial debt, then the economy may run into recession. So that is why financial debt is very, very important. Then the ownership status, who owns the bank? Is it privately owned? Is it publicly owned? Are there foreign banks within the economy, within the financial institutions? Those will also impact on the lending habit or the lending culture within that particular economy. For instance, if most of the banks are owned by the government, then there will be more access to mortgages within the economy. However, if most of the banks are owned by the private sector, then private sector, because they are into business, they may not be willing to lend as much money to people because of the long term or long period which a mortgage usually goes for. So those are the impact. Then I look at the macroeconomic factors. So you can't divulge an economy, if the banking system is within the microeconomy. So if there is a robust microeconomy, then there will be a robust financial institution, then the bank can be able to grant more credit within the market. So I look at output within the economy, inflation, then the crude oil prices, because Nigeria is a monocultural economy, that is, depends on oil for its survival, oil revenue for its survival. Then I looked at institutional factors, such as the development of the insurance sector, government policy effectiveness, political stability, and corruption. So if there is a robust insurance sector, then banks will be willing to lend, because insurance sector can absorb the losses they are going to make if, for instance, a particular credit does not perform. Then government policy also to give guarantee if there are shocks in the economy, and if there is political stability, that will encourage more credit to be lent, because people, banks or financial institutions will not be willing to lend when there is political instability within the economy. And lastly, we have corruption. So when there's control for corruption, effective control for corruption, then the banks will be willing to lend. So that's the structure of the model. Then I looked at, these are the data sources. So the Central Bank of Nigeria, World Bank, Bankscope, Institute for Economics and Peace, Transparency International. So this particular data set looked at a period where from 1981 to 2018. So this period covers a period where there was restructuring in the Nigerian banking sector, there was a restructuring in the insurance sector, there was a significant increase in output increase in Nigeria from that period. That was the period when Nigeria became the fastest growing economy in Africa, and a period where Nigeria was output increase. That period was characterized by the high inflation, and within that same period, there was debt relief and cancellation of debt, and the external reserve of Nigeria increased significantly. So Nigeria was positioned, the economy was positioned in such a way to support the development of the mortgage market. So using a four-stage model, so these are my findings. So I will quickly run through the findings. So the bank internal indicators such as credit risk, operational expenses, capital base, and total assets, that is the size of the bank, we could see that it does influence the lending pattern of banks. So banks that have a very low risk exposure, that has low operational expenses, that have good capital base, and you have a very large asset size, are always willing to lend within the mortgage market. So they're always willing to grant access to people within the mortgage market. So secondly, another finding is that banks' lending behavior is influenced by the industry. So the industry where the banks operate always influence their lending. So particularly if there is the presence of market power within the bank. So market power could influence the lending activity in the mortgage market by adjusting interest rates, deposit documentation requirements. Also, the financial debt in Nigeria is not that big. However, it's encouraging, and I could say it could withstand to a little extent, to a reasonable extent, the shock that could come from any external shock. So this provides evidence that financial institutions in Nigeria can actually participate effectively in the mortgage market. Also, we have macroeconomic indicators. So macroeconomic indicators such as growth in the GDP, inflation rate, crude oil prices can influence bank supply of funds in the mortgage market. So from based on these findings, we could see that there is a rapid growth in the economy over the last 10 years, which is instrumental in the growth of the mortgage market. Inflation rates did not discourage banks from lending in to also to buy their desired property. However, we could see that oil volatility actually significantly impacts revenue, which creates a contraction within the economy. And once there is that contraction within the economy, then banks may be reluctant in lending. However, this is the case in this instance. And also, I could see that we have institutional structure. Institutional structure do have a significant impact on the supply of mortgage finance in Nigeria. For instance, political stability, development of insurance sector, effective government policy, and corruption has a significant impact on the willingness of banks to lend the credit needed in the Nigerian mortgage market.